Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Light Pro Asset Management. It is October 14th of 2022. And of course, we're glad that you could join us this week because it's an important week. It's an important time in the overall market. We know that we're going through that continued bear market storm, not just in the stock market, but in the bond market as well, as we continue to digest these inflation reports, as we continue to understand what Federal Reserve policy is doing, not just to the bond market or the stock market, but the overall global economy. And right now, to summarize everything, it's important to continue to play defense. There is a storm approaching. It's the title of this week's presentation. And we've been in a storm, but the worst part of it, we think, has yet to arrive. And there's two ways to play it. There's really three ways: through cash, through defense and hedging, and of course, through net shorting. In other words, by shorting the overall market in areas of particularly high risk premiums. And so we're going to go through all the different strategies that we're deploying on the defensive side to not only help clients preserve money, but also to help make some money during this recessionary period that we appear to be heading towards. So again, title this week's presentation, A Storm is Approaching. Now, we saw that inflation accelerated, and then we saw a very strange day on Thursday where after 3 days of selling, markets reversed and went straight up. So immediately we start getting the calls. Hey, Rob, is this the bottom? Should we start buying risk? Should we start taking the hedges off? And our response was, well, A, we already took some of those hedges off in anticipation of an oversold market rallying into a bad CPI report. But B, absolutely not. Now's where you reapply the hedges. Now's where you double up the shorts. Now's where you go on offense in terms of going after expensive assets and shorting them. That's the game plan. Not to try and bottom pick this, because if we look at the yield curve plumbing to new lows, that is not a sign of pending recovery. That is not a sign that, hey, we need to suddenly up risk and buy some profitless tech. What changed? What changed when markets went up on Thursday versus every other day this week when they went down? And by the way, I'm recording this on Friday, and markets sharply reversed the downside, and those hedges did pay off for us today. So again, nothing has changed other than inflation got worse. Inflation expectations got worse. And stocks went up for a day, which gave us better prices to short them at. That's the only thing that changed. So today's agenda, we're going to review the implications of that most recent inflation report, what it means for your money, what it means for the portfolio, and how we're preparing for not just the current storm we're in, but the center of that economic storm. Now, we used a slide last week. I adjusted it a little bit, but we want to reiterate this message of minding the gap. We've been in this inflation cycle that was accompanied by strong nominal GDP growth. The difference is now we are transitioning from the inflation cycle to the recession cycle without fully killing the inflation cycle. So what does that mean? That means that asset prices likely need to come down to kill off the inflation cycle. When we go back to 2008, when we go back to 2001, when we go back to 1991, when we had those recessions, and 2020, mind you, when we had those recessions or those shocks to the economy, the Federal Reserve could respond by cutting interest rates, printing money, and lifting risk assets to make the mood of Americans and investors around the world better by seeing their accounts go up in value. This time around, your account value is the problem for the Fed. They don't want to see your account values go up because in their mind, that's feeding inflation. They want to see your account values go down because they feel that's the only way to kill the inflation cycle. And to do that, they need to break the economy. Unfortunately, the whole soft landing that we keep hearing about, that's fantasy, okay? That's pixie dust. Don't listen to that. It's likely going to be a hard landing. People are going to lose their jobs. Your account values are going to go significantly down if you don't play defense. Operation break the economy. These are the things that we have to be aware of and play defense against. And that's how we're doing that through hedging and shorting risk assets. So the Fed isn't bluffing when they say they're going to break something, or I should say that they're going to continue to hike rates. And really the only thing that's going to stop them is if they break something. Now, as it relates to Thursday's rally, again, let's not overcomplicate this, people. At the end of the day, during a bull market, sometimes you get some down days. And during a bear market, guess what? Sometimes you get some up days. We were down for 6 straight days. The market was oversold. Technology in particular was very oversold. So what did we do? Tuesday, Wednesday, we reduced some hedges. We didn't remove all of them because we're bearish. We removed some of them though. We still went down on Thursday. That's okay. But we removed some of the hedges, and then on Thursday when risk assets rally, guess what we did? We shorted, again, a lot of those same assets at much higher prices. And they paid off today. That's what you do in a bear market. You short more when you get these short cover rallies. And in a bull market, you buy the dip. But you don't do that during a bear market. And so that's really what we were working on. At the end of the day, Thursday, short cover rally. Notice something about these bear market rallies, by the way. Every single bear market rally that we've had since June is getting smaller in time and duration, right? 17.4% over 3 months, 60 days was that first bear market rally. Then we had a second bear market rally in September. That was about 5.2% in 6 days. Then the third bear market rally, September 30th to October 4th, was about 5.7%, but only 4 days. And then this time around, it only lasted a day, 2.6%, and we immediately sold off on Friday. What does this mean? As you're getting smaller and smaller bear market rallies, it's all becoming a crescendo to a particular event, an event where something breaks. And the Federal Reserve is going to screw it up again, and they're going to break something. And if you're long risk when they break something, you're going to lose a lot of money. And we think that basically the Federal Reserve and the economy are this truck, and they're heading straight for a cliff. And our job is to get you off that truck. And then when that truck crashes, we can go and pick up what's inside that truck at super cheap prices. That's our objective right now. Don't try to get pulled into these short cover rallies that don't mean anything. Notice what wasn't up yesterday. Growth stocks were not up yesterday. ARK funds were not up yesterday. High yield bonds were not up yesterday. All the junk was actually down on a significant up day. That should be a warning sign. The top 10 intraday reversals that we've seen in history. So yesterday we had close to a 5% daily reversal from the peak, from the trough to the peak of the day. Again, this was, let's see, 1, 2, 3. This was the 5th largest intraday reversal on the S&P 500 and the 4th largest intraday reversal on the NASDAQ. But notice the dates. You know what they all have in common? They all occurred during recessions. And no, not the bottom of a recession, during recessions where markets ultimately plumb to new lows. The message is be careful, play defense, play caution, short if you can. That's the message. And notice what happened yesterday. Credit risk rose, it didn't go down. So HYG and JNK, those junk bond and high yield bond ETFs, they went down in price. So again, ARK funds, the IPO ETF, the social media ETF, the software ETF, all of these things, high yield credit, junk credit, all these things that are high risk went down in price on a very, very violent upside day. That's a warning sign. That's not an endorsement to go long risk. And so we maintain our hedges, right? We talked on Tuesday. Our first line, the center of the storm stocks that we're using as the primary way to hedge, in this case technology, they got oversold. So what did? We scaled those hedges down, rotated those hedges toward the small cap stocks and the financial stocks. We brought down our volatility hedge because VIX got to 34, 35, NASVOL got close to 40. So we brought those volatility hedges down. What did we do on Thursday when they rallied? We reapplied those hedges, right? So if you ever played hockey, ever watch hockey, you know about hockey, you got 3 lines. You got your goal scorers in the first line, you got your support players on your second and your third line. When your first line gets tired, you get them off the ice and you put the second and the third line in there. And when the first line is well rested, you put them right back on the ice. And that's how our hedging program works. When those implied vol premiums skyrocket, in other words, demand for life insurance a month from now gets expensive relative to life insurance today, we reduce our hedges. When that future life insurance gets cheap for our portfolio, we reapply the hedges. That's how it works. So you're going to notice a lot of trading, a lot of activity as it relates to the hedges. As for the market, a lot of this risk remains very top heavy. Apple, Tesla, Google, Microsoft, Netflix, all those stocks that make up the bulk of the S&P 500, almost 27% concentrated in 7 stocks. Those are the areas right now that we think are the most exposed to the market going down. Why? Because everyone owns them. The Swiss National Bank this week disclosed that they own $10 billion, billion with a B, of Apple, $8 billion of Microsoft. Why? Because of Vanguard funds and Vanguard ETFs and all these passive ETFs and retirement funds. Everyone owns this stuff. And it's the most owned areas of the market that are up next. It started with growth. It started with small cap. It started with SPACs. And it's all migrating its way toward the biggest areas of the market where everyone is exposed. That's why we have to be careful. And as it relates to inflation, it's sticky. When we look at shelter CPI, it's going parabolic. And when we look at the price growth on the chart here on the left, that it's composed of shelter, medical care, food at home, utilities, and wireless services, that's not slowing down either. So unlike commodities or oil or copper, which can go up and down quite violently because it's a capital market asset, this stuff is very hard to turn around. It's sticky. So that path to going to 8% inflation to 2% is a super long one, and one where the Federal Reserve has made clear they're not going to stop raising rates until they break it, which means your money is exposed to when they break stuff in the process of doing that. So the bottom line, lots of noise, but the backdrop for stocks, in our opinion, has worsened, and the Federal Reserve is likely to keep pressing the brake. Each successive rally within this bear market is getting shorter. That's a danger sign. That's a sign to get more protective, not more risky. The inflation report only increases the conviction that the Federal Reserve is going to continue to increase rates, and that's leading to higher credit risk across the globe. No bueno for risk assets. So thank you again for all your time. Thank you for your business. And if you have any questions or concerns, please feel free to reach out to myself or any of your advisor, or anyone else here on our team. Otherwise, have a great weekend. Talk to you soon.